So this presentation really is on construction and renovation financing. They're kind of one in the two, but just slightly different as far as the financing part is concerned. Yeah, so let me just dive right into it. And we'll ask a few questions along the way that's kind of relevant to what we're talking about, and then we'll have more Q&A towards the end for everyone. Is everyone okay with that?
Yeah.
Okay, great. So construction financing. So there are a few similarities between all construction financing, and I'll just go through a few of those right now, just what the similarities are and what to expect. Okay, so for construction financing, there's really 2 to 3 forms that's available to you from the bank and from a private lender. They both do the same thing. The only difference is the private lender will be a little bit more flexible and will be a little bit more expensive because of that flexibility as far as interest rate. So some of the similarities you can expect with most construction / renovation financing. The first thing would be the appraisal. Okay, so most lenders, even the banks, will want an as-is and an as-complete appraisal. Basically, the as-is will be what the current condition is, whether it's torn down, it's a new build, custom build, it's just the raw land. That is what they're appraising as the as-is evaluation. Sorry, guys. The other thing that they will need up front is the as-complete renovation. Now, for the as-complete, it's really important that you have your plans and your renovation budget up front, so you can give it to the appraiser, so you get a better value on your as-complete portion of the appraisal. The second thing that's kind of similar with these type of loans is they'll ask for a progress report. So I would say this mainly will affect the construction loan versus a renovation loan. Renovation loan, the progress report will kind of be just at the end once it's completed, where a construction loan, it'll probably be several appraisal or progress report that you'll need along the way. Progress report can come from an appraiser, a surveyor, or a city official that the lender choose to appoint. Another thing that's similar is the insurance policy. You'll need an insurance policy that covers the fact that you are doing a renovation and construction, which means basically you're devaluing the property and then building it back up in equity as you repair it and as it goes along the process. Capital is another thing that's needed. Now, when you say capital, that's like the cash you have on hand before the project starts. So there's hard costs and soft costs associated with every type of renovation / construction loans. The soft cost is really like the appraisal, the progress report, the insurance policy, closing costs, those sort of things. And the hard costs would actually be the renovation costs, like the cost of the materials or the cost of the labor.
Michael, are you still
Yep.
showing? I'm seeing a black screen. I don't know if are you guys seeing the screen?
Yeah, I'm showing. Are you guys able to see? Maybe my screen share stopped. Let me try it again.
Yeah, because I'm okay, it's back.
Okay. What about now? Is it better?
Yeah.
Okay. Does anyone have any questions so far?
Any questions?
No?
I don't know if you'd want
Okay.
me to go into a little more about what they expect to see in the progress report.
That's what I was gonna ask.
Oh yeah,
Yeah, the progress report.
Okay. So
And why? And can you yourself, like, can they not? Can it be you that gives them a progress report?
okay. So the progress report is really completed once you get to certain stages of the renovation. So, sorry, I don't know if I'm still screen sharing. Can you guys still see my screen?
It went black screen again.
Jeez. Okay. Sorry. The joys of doing this on the phone, right?
That's okay. As long as we're still able to get it done today.
Right. Okay. You guys can see it, right?
Yep.
Okay. So the progress report is, I would say that's more so needed for a construction loan versus a renovation loan. 9 times out of 10, you won't require a progress report on a renovation loan, but 9 times out of 10, you will require one on a construction loan. The progress report are really in between your draws. So every renovation project, there's certain stages that you go through from start to finish. So, for example, you know, the first part, like the first 30% of the project may be, you know, breaking the ground and laying out the foundation. That might be the first part. Once that's completed, the lender will send an appraiser or someone from the city to kind of inspect what you've done so far to make sure that it's within guidelines and it's following the code of the city, if that makes sense.
For the progress report though, like, are they expecting to see, like, what do they want to see though? Like, let's say pictures?
They want, no, well, they will take pictures, yes. The appraiser or the surveyor, whoever is doing the progress report, will take pictures. It's almost like a partial appraisal, right? It's the same process. They look at it the same way as an appraisal, but what they're doing is they're looking to inspect to see what you've done so far to make sure that it's done correctly. That's really what the progress report is for.
Okay.
To make sure that you're following city code.
Yeah, so that's not even the contractor that would do it. Yeah, it's actually, I guess, whoever the...
It's a third party, yeah. It's usually a third party.
Oh, okay.
Yeah. And the reason why they employ that third party is because, you know, they want the information not to be biased, and they want it just to be true to whatever is going on with the property.
Mm-hmm.
Yeah, so really that's what the progress report is for. It's not to say what the value is currently or anything like that. It's mainly just to say to the lender, okay, everything is on point. You know, the foundation was laid properly. Everything was sealed correctly. All the waterproofing was done correctly, and those sort of things.
Okay. And so, and I'm assuming that would be an extra cost, right? Is that an extra cost?
Extra cost, correct. That is a cost that's covered by the borrower.
Okay.
Yeah. So
And
usually on a
yeah, that was your question. It was my question. How much?
Yeah, usually the progress report you can expect the same cost as an appraisal. So anywhere between $600 to $1,000, depending on the location, the size of the property, and yeah, I mean, I think that's mainly it, the location, size of the property, but it's going to be about the same cost as a regular appraisal.
Okay. Anyone else have any other questions?
Yeah, is this progress report, let's say that the project length is like 8 months, something like that, a year. Like how often this progress report has to be presented, or is this 1,000 for the entire project, or is based on timing?
Okay, correct. It's sort of based on timing for the lender. So it's when I say timing, I mean the stage that you're at with the renovation. So again, let's say the foundation that takes you 2 months to do, right? Once you complete that portion of it, you will get the progress report. Let's say that's 30% completed, and that progress report will basically tell the lender where you're at as far as percentage complete, what you've done so far, and how well that portion of the project was completed. Right, so the progress report is usually in stages. When you do the renovation loan, it's usually broken down into 4 draws for most lenders. I mean, they tell you can do unlimited. Some allow you the option to do unlimited, but that can be costly because for every draw, there's a fee associated with that draw.
Mhm.
Okay, so you kind of want to limit it to 4, 5, maybe 6 draws. That way you can keep your costs down.
Makes sense. Any other questions from anyone else? I think we can go on to the next slide, Michael.
Okay, great. So then we're gonna now we're just gonna point out the differences between the 2 types of loans, and let's see how that plays out. Okay.
Mm-hmm.
So the real difference is the type of loan that you get for your project. So really, there's 2 sort of renovations that you can do. You can do custom build from the land up, or you can do one that's the building is already there. The building just needs cosmetics or whatever the renovation is. So those 2 loans, the first one includes acquisition, so the lender will help you acquire the land and pay for the construction, and the second one is just the lender's just paying for the renovation. Okay, so that's the major difference. It's just the type of financing that you get. The other difference will be in the draws. Again, some lenders do 4 to 5 draws. Some lenders do a scheduled draw, meaning that stages like 30% complete, 40% complete, 60% complete, those sort of percentage. And then other lenders allow you to do unlimited draws. Again, you may not want to do that because that can be costly. They charge you for every time they have to do the draw and issue the funds, right? Because they have to go through their bank account and their accountant. So you're paying for that cost. Okay, so those are the only and 2 major difference between the 2 types of financing. Any questions so far?
Are they almost always private lenders, or can they be like, or can you get a construction loan from the bank?
Correct. You can get it from the bank or a private lender. The major difference between the 2 institutions would be how fast they're able to move on the project, and also how flexible they are if any issues arise along the way. For instance, if we go with the bank, I know right now most banks are extremely slow when it comes to construction loans. I mean, you're talking at least 2 to 3 months of a wait time just to get an answer from the bank as far as an approval. Private financing, you can get it as quick as a week, 7 days, 7 business days. So that's the major difference. And then the other difference is with the private financing. Let's say, for instance, you had an issue with one of your contractors and they decide to put a lien on your project. The bank, if that situation arises, it would almost halt your entire project. Where a private lender, they'll be a little bit more flexible. They'll be willing to work with you, help, do whatever it takes to get the lien removed so you can continue with the project. whether that's, maybe give you a little extra funds to pay that contractor off or whatever the case is. But they're usually a little bit more flexible. Where the bank, it's like, if you mess up or if something goes wrong, really you're paying for it.
Okay.
Okay. Awesome.
Thank you.
Any questions? Any other questions?
I have a question about the draws.
Mhm.
What are all the other expenses, I guess, related to the draw? We spoke of one, the report. Anything, what else is,
Right. So the report and just the draw fees that the lender charges you. So that could be anywhere from $100, $200 all the way up to like $500, $600 per draw.
okay, thank you.
Okay. Awesome. Everyone can still see the screen?
Yep.
Okay, perfect. So we'll move on to just some examples. Two examples to kind of put it all together to show you the difference in financing. Okay, so we have Project A, Project B. I didn't put a description of Project B, but Project B was a purchase plus, and Project A was just a property that was demolition down to the studs, and then construction financing was applied for to bring it back up to retail status. Alrighty. Everyone knows what a purchase plus is, or have heard of a purchase plus?
Just in case they haven't, maybe you can.
No.
No? Okay. So a purchase plus is when you're buying a regular property, like a regular home, and sorry guys. Yeah, you're buying a regular home, and then the home may need some repairs. It may have like an unfinished basement, an outdated kitchen, outdated bathroom. It's ready to move. It's move-in ready. You can move in and live in it, but it just needs a little bit of updating. So with the purchase
so
plus,
that would be my situation then.
yeah. So the purchase plus, you would buy the property, and you would also get financing to renovate it. It's similar to the construction loan, except this one is move-in ready property. It's a property that technically you don't need to fix it up, but you want to fix it up as the owner. Okay, so then you would get the purchase plus loan. There's also another, just a regular construction financing. Like, let's say you already own the property. So I guess that would be another, like, Project C. Let's say you already own the property, let's say 5, 6, 7 years, and then now you want to finish the basement that's been unfinished. You can get a construction loan for that, which is a specific loan that helps you repair your home, if that makes sense.
So
Does that make sense to everyone?
you would get a construction loan instead of a renovation loan for a basement?
I mean, sorry, not a construction, sorry, renovation loan is what I meant.
Oh,
Thanks, Diane.
no problem.
Yeah, you would get a renovation loan for something like a basement because it's smaller. You don't need to do draws, and it's usually they give you the cash up front so you can complete everything at once.
And both loan types are secured, or does it depend on the amount?
It is secured. Anytime you're doing private financing, well, anytime you're doing any kind of financing, it's usually secured until you pay off the lender, right? So, for instance, on a construction loan, the lender owns the property until you get the 100% complete and you pay it off, and you refinance or whatever you want to do to pay that lender off. And then when you refinance it, now the new lender, whatever the loan to value is, they own that portion of the property, if that makes sense.
Yep.
Yeah.
And sorry, I have
Okay.
one more follow-up on your project A question.
Mhm.
So a construction loan can happen like it's when the house is basically not considered livable. So it doesn't have to be actually like a full gut or like a full tear down. It's just it's a construction loan is used when the house is not livable.
Correct. Correct. The reason why you would need a construction loan, because no A or B lender will touch the house because it's not livable. Usually A or B lenders only finance livable homes, properties.
Okay.
So you would do a construction financing, and usually it will be done through a private lender.
Okay, great. Thank you.
Yep. And again, one more point. The reason why it will be a construction loan, because the lender will want to know your progress along the way, right? They're not just going to give you $200K, have you rebuild the entire home, and then do an inspection at the end, right? It's, again, they own the property until you refinance or you own it back again through refinancing. But it's just a way of securing the property. That's why they do it in draws. So that way they mitigate the risk a little bit better.
Makes sense.
Make sense? Make sense?
Yep.
Okay. So in project A, so for this project, this is a real life example of a file that I did over the last few months. So for this project, there was a first position loan for 70% of the purchase. So the purchase was for raw land to do a custom build on. So the borrower, they needed an acquisition loan, and they also needed a loan to get the project or the construction started. So this type of loan was done through a private lender, and it was an acquisition loan and a construction loan in one. The construction part of the project was 100% financed by the lender. The acquisition part of it, the lender gave 70% of the value, the as-is value of the land. Okay. The interest rate on this one was 8.5%, with a 2% lender fee. So the total cost needed was down payment plus closing costs plus legal. In most of these type of transactions, the borrower pays for the legal costs, whether it's your lawyer or the lender's lawyer. You're pretty much responsible for all of those costs. Alrighty, so project A, just the numbers to break down a little bit. So the land cost was, I'm just using round numbers for simplicity's sake. It was $2 million. The hard cost, which is the actual construction budget cost, was $1 million, and then there was $500K in soft costs. So that included the appraisal reports, the architecture, permits, environmentals, et cetera, whatever else is required by the lender. It's usually part of the soft cost. And this total soft cost was $3.5 million for this project. Okay, so some of the fees associated with this type of financing. So the lender charged 2% on this loan. So if you take 70% of the purchase price, which the lender gave you for acquisition, that's $1.4 million. And then 2% of $1 million, which was the renovation cost, construction costs, and that one was 100% financed by the lender. So you have a total cost of 2.4 mil that was charged at a 2% rate by the lender. So the fees for this transaction by the lender was 48K. Okay. Any questions so far?
I was just wondering, with the soft costs, would that also be considered things like appliances, like if you're starting from the ground up?
No, appliances is not considered soft cost.
Okay.
Because
Is
that
it ever
comes
included?
after the renovation. What's that?
Okay. No, I was just gonna say, is it ever included in like, is that something that the lender would also pay
No,
before?
no, it's never included in the cost.
Okay,
Yeah, the
thank you.
appliances, it's usually considered like extra. I mean, because that's subjective. You know, you could put stainless steel appliances. You could put, you know, black, white. You know, put one with a TV in the fridge. You know, you could do whatever, and it'll usually accumulate to a different cost based on what type of appliances you get. Okay, so yeah, that's not typically included in the soft cost.
Anything else that would be included?
No, I mean, soft cost is really, when I think soft cost, I think of what it takes to get the project off the ground, right? So you'll need to get your appraisals, you'll need to get your permits, you'll need to get your surveys done, all of those sort of things. That's typically out of pocket. Usually you pay for the soft cost even before you start the project.
Mm-hmm. Okay.
Okay. That was a great question. Any other ones?
Looks like everyone's good. We can go on.
Okay. So just some fun facts. For every construction project, you will always maintain the loan to value that the lender initially gives you. That's what they're expecting you to maintain throughout the entire project. So anytime, so say for instance, you have a home that's you're looking to renovate, and you decide to take down the drywall, you decide to take out the insulation. When you do that, you're devaluing the property. So the value goes down until you start to repair it and fix it back up, then the value comes back up. So same thing with a construction loan. The lender expects you to maintain, well, the value will always be at 70%, meaning that, so when you're doing your draws, so the draws will maintain you at 70% of the value of the project, if that makes sense. Does that make sense to everyone?
Yep.
Okay. Yeah, so usually the funds are issued in draws. Typically there's 4 draws, but there's a takeout financing, which is technically not a draw, but it's a fee associated with that. And that's when you're 95 to 98% completion of your project, and then you're getting financing like you would do at a regular bank. So then on the takeout, you will go to an A or B lender to get, you know, your 1%, 2% interest rate of the new value of your home that you fixed up. So now we went from, let's say, a $2 million value. Now you fix it up, you put $1 million in renovation, and then now your home is worth $3 million, right? So that new value is what you would be. No, sorry, you would do a refinance based on the amount owed. So, for instance, the lender lent you $1 million for the construction, plus 70% of the acquisition of $2 million, which is 1.4. So on refinance, you will need to refinance $2.4 million with the bank. Is everyone following that?
Yeah, unless if you decide to sell it.
Exactly. So thank you, Diana. That would be your second exit strategy and the ultimate exit strategy. When you sell, that's the ultimate exit for any lender. If you're doing a project and you're not sure how it's gonna go, it's always safe to say that you're gonna sell at the end, even if you change your mind, because when a lender hears that you're gonna sell, the project becomes more desirable now, because they know that, you know, you may or may not be able to refinance, but if you turn around and sell it, there's a pool of buyers who would potentially buy the project or your new home. So they're okay with that, and they like that type of exit better than a refinance, to be honest.
That's good to know. I didn't know that.
Yeah, because usually on refinances, as some of you may or may not know, there's usually a lot of issues that come up on a refinance, whether it's qualifications or, you know, something in your bank that the lenders see that they don't like, or, you know, there's always something when you're dealing with the bank. So lenders know that. I mean, they're banking themselves, so they know that. So if you tell them you're selling, it makes your project a little bit more favorable. But if you do really plan on living in it and refinancing, and you can prove that you have the funds to refinance and the capability to refinance, that works as well.
Makes sense. And I guess that would happen all at the beginning anyways, right? Like when they
Yeah, you would disclose that up front. Yep. Yep. Any questions?
I think we're good.
Okay. Okay. So as I mentioned previously, one thing to keep in mind when you're doing these type of loans or financing, the lender owns the property or the building until you're able to refinance or sell. Like technically you don't own it until the project is complete and you're able to, like I said, either do a refinance. Well, if you sell it, you still don't own it, but the lender owns it the entire project. It belongs to them. It's their asset. Alrighty, so here are just a breakdown of some of the upfront costs that you will need for this project. So the appraisal that was required on this loan was the as is and as complete appraisal, which came up to about $2,000. There was an environmental report requested by the lender that costs about $3,000. There's a builder's risk insurance policy that was needed up front, and that was $25K, and that had to be paid out for the full term of the loan. There was a down payment. It should be $48K. There's a down payment of $48,000, which was at 30% of the total cost. Legal was $5K. Sorry, down payment was not. Sorry, I think this was $600K. Yeah. Legal costs. So the lender fee was $48K. And closing is approximately 1.5% to 2%, which includes land transfer, legal fees, all of those sort of things. And then one also important thing to remember on these type of loans, almost always there will be a 10% holdback by the lender, and that it's not their policy, it's policy of the government of Ontario. So they stipulated that any construction loan, the lender holds back 10% of that loan for anything that could go wrong within the project. All right.
And hold back until when? Like, what do you hold? Like,
Until the project is completed. So all of these costs are held by the lender right initially, right up front. There's another fee that I should include in here. So this one is a interest reserve. So what some lenders like to do, they like to collect the interest up front. So let's say they're charging you 2%, that's $48K. They would take that and put it in an interest reserve. Sorry, not the 48K, the whatever the percentages that you got. So the 8.5, 8.5 of the loan, right? So the loan was, what was the loan amount? 2.4 mil. So if you do 8.5% of that, that's 204K. Now the project may take 6 months. So that's 102K. So what the lender will do, they will hold that 102K back up front. So they'll take it out of the loan as an interest reserve. So anytime your payment is due, the lender will go into that interest reserve, withdraw the monthly payment, so you don't have to pay it out of, every month. Is everyone following that?
yeah. So, and does that the interest reserve? They do it for, like if it's a 1 year, but they'll do it for whatever the percentage is. It doesn't matter how long the term is, and then afterwards they just start collecting whatever's left remaining from you.
Yeah, I mean it's based on the term of the loan, right? So initially up front, you will let them know, I need a 1 year term, I need a 6-month term, I need a 3-month term, however long you think your project will take to complete, right? You will know that best based on your budget and based on your contractors and all of that. Like that you will know up front before you even approach the lender.
Okay, so it would be the full term, whatever you decide. They'll have the
the full term, exactly. They'll hold the interest rate back for that entire term. So if it's a 6-month term, there'll be a 6-month holdback. If it's a 12-month term, there'll be a 12-month holdback.
Okay.
Okay. And yeah, that's just some of the costs. There's a few in there that I'm kind of leaving out, but it's nothing major. Just a couple $1,000s here and there that may come up, and this varies from lender to lender. So some lender may require certain reports or certain appraisals, where other lenders may just ask for something completely different, right? So one lender may say, okay, I need an appraisal report, I need your budget, and I need your your permits. Another lender may say, I need your permits, I need the environmentals, I need the city report, they may ask for everything under the sun. So it varies from lender to lender what your cost will be, your total cost. Mm-hmm. But this is just a general idea of what to expect.
Makes sense.
Any questions? Yeah, okay. All right, so let's move on to project B. This one's kind of simple. So this one is a purchase plus, and I also give another example of just a regular renovation loan. So this type of renovation/construction loan is called a purchase plus. So really, this is when you buy a retail home that you move into, it's move-in ready, and you may want to do some updates to the property. So one option will be to get a purchase plus. It's kind of like an acquisition and a renovation loan in one. Okay, so this you can get from the bank, A or B lender. and they can finance it up to 90% of the value of the purchase. Okay, so let's say you find a home at 700K. You approach a lender or a broker, say, hey, I want to do a purchase plus. They say, okay, 10% down. The other 90 will be insured, will be financed by the lender. Now, up to 90%, that's typically an insured mortgage. So expect to pay CMHC fees. This option is also available on the uninsured side, up to 80% with no CMHC fees. Okay, on this loan, the interest rate is a lot better. It's 1.5%, because it's from an A lender, and that's 5-year fixed. 5-year variable. And the down payment was 10%. Typically, they want the down payment to come from your own resources. And then again, some of the numbers on this project. So the purchase price, let's say for argument's sake, was $1.5 million. The hard costs, this project needed, the basement was unfinished, and the kitchen and the roof needed updated. So this total project was $300K. Soft costs between the architecture permits, the appraisals, all of that was $50K. So total cost of $1.5 million. And the lender financed 90% of that $1.5 million. Now for this type of loan, that hard cost is paid up front by you and then reimbursed by the lender at the end of the project. Same thing with the draws. You have to pay that 30% of your budget up front, and then once you do the progress report and it gets back to the lender and they're satisfied, they reimburse you that 30% that you just coughed up. Okay, so these costs are really upfront costs, and then you reimburse at the end. Okay, everyone's following that?
And the renovation, the full renovation for this one is 300K, right? Oh, 300?
Yeah, 300K.
300 plus 50 technically, I guess, right?
Yeah, exactly. 300. So 350 would be the total cost. You're pretty slick, Diane. I like that. Yeah, 350 will be the total cost. Plus, of course, closing, whatever else is included. So 350 plus, I would say, closing costs would be a total cost.
But you're saying that amount has to be paid up front, right?
Yeah, on this type of loan, the lender, like, you would still do an appraisal as is and as complete. You won't do any progress report because, you know, it's just it's a different kind of loan where they're not really giving you the money again up front. It's at the very end once the project's completed and they do the final inspection.
So what's the
9 times out of 10?
Sorry, what's then the benefit of getting a renovation loan if you're just getting it at the end?
Because I'll tell you why. You will get your project financed at the bank at a low interest rate. So that 300K technically will only cost you whatever the interest rate the lender is charging. So that 1.5 is what that 300K costs you. Yes, you paid it up front. Same thing with the construction. You will pay it up front, and then once you complete it to a certain progress, 30% complete, then you get reimbursed off the cost you just spent, right? So the lender is not going to give you the money up front per se, because frankly, they don't trust you with their money. So they want you to spend it, and then once they're satisfied, they reimburse you.
But like, let's say for a homeowner, because I feel like a renovation loan would be more for a homeowner then, where they get the construction loan, because usually the purpose is they don't have the money for the construction loan, like let's say the full amount, so they would want the loan.
Right. I mean, for both projects, you will have to have the capital up front in a way, except for project A. I mean, you're not going to have a whole $1 million up front in your bank account, right? If you did, you won't need the bank.
Exactly.
So that one, you probably, let's say you have 300K, which will probably, if you take the draws and divide it into the hard cost and soft cost, that's probably about 300K per draw. So the lender is looking for you to have at least 300K plus, whatever else you have to pay to get the project started in your account.
Yeah.
Right. And then once you spend that money, you get the foundation in, you do whatever you need to, waterproof and all of that. And then you get the progress report completed. You send it to the lender once they're satisfied and they're okay with what you've done so far. They'll now reimburse you on the second draw, that 300K that you just spent.
Mm-hmm.
So the initial draw is usually just to acquire the land and to get everything off the ground, mainly just the land.
Mm-hmm.
Then once you do the first section, you pay that up front, you get the progress report, the lender comes out or sends someone out, they look at the work done so far, they're satisfied, they reimburse you that 300K. Now you move on to the second part, whatever that is, putting in your, putting in everything else, the walls, windows, roof. Now the property is sealed, you're, let's say, 60% completed. The lender reimburse you for that money you just spent. The next step, you may need rough-ins, you may need electrical, all of that put in. That's on the third draw. The lender, once that's satisfied, the lender's okay, they deposit the next set of funds. Then now you do all the finishing touches, you seal everything off, you paint, you put up your countertops, your fixtures, all of that. Now you're 90% complete or 98% complete. And at that point, the lender expects you to refinance
Mm-hmm.
to pay them out.
Yeah.
Or if you plan on selling, then you just go to 100% completion, and then sell the project once you're done.
Mm-hmm. The construction loan, I feel like it makes sense, but for the renovation loans, these kind of renovation loans then are just for people that are always going, like it's more for homeowners, or I guess people that are going to BRRRR, I guess, let's say. Right?
Not really. It's hard to do a BRRRR purchase through the bank. If they know it's going to be a BRRRR and it looks like a BRRRR, they won't finance it.
Mm-hmm.
So to your point, yes, it will mainly be for homeowners, people who are looking to, live in the home for the next 5 years, 10 years, those sort of things. So they want to take this home and now turn it into their dream home. So they updated the kitchen, make it the kitchen that they wanted. They fixed the basement up, and then they're going to live in the property for the next 5 to 10 years.
Yeah.
That's ideal for the Purchase Plus.
Yeah. So I guess this Purchase Plus is kind of like a way of doing a BRRRR, isn't it? Because it's like you have a mortgage on there, and instead of refinancing.
No, it's not a BRRRR, because a BRRRR you're doing two financing. Where this is just they give you the approval up front. So you get approved for the purchase and the renovation cost up front, right? So the purchase, in this example, the purchase price was $1.5 million for the house, and the renovation cost was $300K. So the lender actually approved you for $1.5 million, but they only dispersed $1.5 million for the purchase, right? They're not going to give you the construction portion of it because they want to make sure that that part is done correctly. So that's the whole reason why they don't give you these type of funding up front. Only when you do an equity takeout, and that would be the third type of financing, you get the money up front. So you do a second mortgage, equity takeout, $100K. I go to the lender, say, hey, I need $100K for renovations to a basement, whatever. I get the approval, the lender gives you the 100K up front. So that would be the third type of renovation financing, which is probably the easiest one to explain and to look at on paper because it's literally just a second mortgage. You get it, you get the interest rate. The interest rate will be a little bit higher. That's why the purchase plus will be a better option. It's kind of the same thing. So think of it this way. You buy the home, you get the purchase plus up front, you're paying the interest rate that the lender charges you for the renovation. So 1.5, you're paying on the 300K. Now the same scenario, you could buy the house, pay 1.5 million, maybe wait a few months, and then now take out a second mortgage to do your renovation. That second mortgage may cost you 9%, 10%, 11, 12%. So really that's the savings of the purchase plus. You're getting the same money at a lower interest rate.
But isn't the purchase plus a second mortgage? It is.
No.
Right? Oh, it's not?
No, it's one first mortgage.
Oh, it's.
That's why they approve you up front for the total cost. Even before you get the approval, they'll ask for an as is and an as complete appraisal. Once you get that appraisal and they're satisfied with the work that's going to be done, they give you the approval for the total cost of the acquisition and the renovation. But they only disperse the acquisition portion of the loan to your lawyer. They also disperse the renovation, but they instruct the lawyer to hold that until the project is completed.
Okay.
So once it's complete, they're satisfied. They'll tell their lawyer now, and will instruct your lawyer to release the funds to you. So that 300K you just paid, you just coughed up, whether you borrowed that, whatever you got the money from. Now at the end of the project, they give you the money back in full, and then you can repay that loan or put it back in your bank account, wherever it came from. And then the beauty of this, now you're only paying 1.5% on that 300K, right? Now, if you had to borrow that 300K from somewhere, that, of course, that's where it gets expensive because you're paying to borrow it and then the 1.5% to refi, or, as the new loan. But overall, the purchase plus saves you a lot of money. Like I said, they do one approval. It's one mortgage, first mortgage for the total cost of the project.
Okay.
Right. And then, and the third example, when you take out the second mortgage, you do the acquisition, let's say 1.5 mil, first mortgage. You wait a few weeks, few months, a year, 2 years, then you do a second mortgage to fix up your basement or your kitchen or your bathroom, those sort of things. And then on that second mortgage, just know that now you're paying a higher interest rate because only private lenders, you can get a second mortgage from the bank too. You can get a HELOC, which will be a slightly lower rate. You're probably looking at about 4.5% to about 6% on the HELOC. Sometimes a little bit lower. Some banks do it at like 3%. But the HELOC would be one option instead of a second mortgage if you wanted to reduce your interest rate. But keep in mind with the HELOC, you have to qualify for the HELOC just like you would qualify for a regular mortgage. So your debt service ratio comes into play with the HELOC, where second mortgage, the lender really don't necessarily care about your ratios. They just want to know that you're able to repay the loan once the term is over.
Makes sense.
Okay, so that's the big difference between private financing and the bank. The bank want to make sure you can, your ratios are in line. You're not going to go over your debt service ratios, and the risk is minimized. Where a private lender would take more risk, they're okay with bad credit scores. They're okay with your ratios being high. As long as you can prove that you can repay monthly payments.
Makes sense.
Yeah. Everyone can still see the screen?
Yep.
Yeah, Michael, I
Okay.
have a question.
Yep.
What about if we're trying of or kind of getting these properties from a wholesaler? Like that extra fee would be just generating into the cost, and are the lenders be able to cover that expense?
That's an excellent question. So when you're doing when you're acquiring properties from wholesalers, there's kind of a word of caution because not every, first of all, the bank won't even look at it when you get it assigned from a wholesaler, because that extra fee is not part of the original purchase, right? Meaning it's not on the purchase and sale agreement from the seller. And really that's what the bank looks at on acquisitions. They want to know what price the buyer and the seller agreed to. And that's the only cost they're going to finance or they look at. When you get it from a wholesaler, of course, the wholesaler will add their fee on top of the purchase price, whether that's 5K, 10K, 100K. That fee is added to the purchase price. Most, I would say 95% of lenders won't even look at a wholesale deal, right? You have to go to a niche private lender that will be okay paying out the wholesale fee. I mean, I would say, actually, let me take that back. The bank will give you a hard time. Almost no bank will finance that. Private lenders, it's kind of 50-50. Some private lenders have no problem with it. Others do. So really, you have to know which lender you're going to approach when you're doing a purchase from a wholesaler. And almost always, only a private lender will approve that type of purchase.
Okay, got it.
Okay.
I
That was
had
an
a question
excellent
as
question.
well. When it comes to the purchase price, can that only be a thing like at the beginning of like within the first year? Is that something that you can add, let's say after you've been there 2-3 years and things?
No. The reason why, because they do the approval up front,
Okay.
to make it one mortgage, right? That's why you get a first mortgage of the full amount. It's dispersed to the lawyer, and then the lawyer reimburses you after it's completed. And yeah, it's one mortgage. It has to be done at the time of the approval of the request.
Okay.
If you go back a year later, then you're really looking for a HELOC or a second mortgage.
Okay. Thank you.
No problem. Any other questions, guys? No? So the fees on this one, again, the lender financed 100% of the construction costs. There's a closing cost of 1.5%, sometimes 2%, but 1.5% is usually a rule of thumb. You'll be within budget if you plan for 1.5%. And that's pretty much everything on construction, renovation, financing. Anyone have any questions?
It's been really informative. Actually, it's very interesting, the difference between the construction loans and the renovation loans.
Mm-hmm.
Yeah. I mean, I know, come on, everyone has to have a question.
Yeah,
Susan, any questions?
Well,
No?
coming back to that wholesale fee, let's say
Okay.
that the lender, you found a lender that it will cover the wholesale fee. Would that be paid on front, or if I have to put it on I have to pay that first and then get that after? How would that look like?
If you're doing the wholesale fee thing, that would kind of be included in the total cost. So let's say you you got a property from a wholesaler, and they're charging you $650 for the total, including their fee. That $650 is what I would approach the lender with. So they will look at the contract. They will see that, you know, $600 was the purchase price, $50K was the wholesale fee, and then now the total price that you're requesting or total purchase price is $650. So that's what they will go off of, the $650 initially upfront.
Okay.
So you wouldn't cover that. The lender will cover that. That's why you have to make sure the lender is okay with it, because some lenders are not okay paying a wholesale fee.
Got it.
Okay, thank you, Michael. Do you want to give out actually your information for anyone that wants to talk to you after?
Yeah. So let me put it in the chat. I'll put my my email. Anyone can reach me on my email at any time. I'll put my phone number. You can text me anytime. I'm usually up late. Okay, so that's my email in there. I'm at Mortgage with Mike on Instagram, Facebook, Twitter. Well, Twitter, I'm Mortgage at Mike. Sorry, at.
So your email is michaelgreene.dominion@gmail.com.
Yeah. Twitter. Yeah. If you search Mortgage with Mike on any of those platforms, you should be able to pull me up. If you put Toronto Mortgage at Mike Toronto, that'll definitely pull my info up.
Okay, sounds good. Thank you so much.
Yep. No problem. Did anyone else have any questions? Juan, anything else you want? Any last minute question?
I don't have a question, but I will definitely reach out because I would like to see how can we work together, because there's a few things on the go, plus my personal property. So I would like to reach out. So I will reach out for sure.
Okay, perfect. And let me put my phone number in here too, guys. You can call me anytime. Okay, that's my number. You know, again, I'm usually up late, so anytime in the morning or evenings, you can reach out to me.
Awesome. Thank you so much. Thank you everyone for coming.
No problem.
It was awesome to have you all, and we'll see you at the next Experts. Bye, everyone.
Bye. Thank you.
Bye. Take care.